Exactly what just happened in the silver market. With less than half an hour left before the weekly close, silver got absolutely slammed hard, then bounced even harder, and then stalled right on the line the big banks definitely did not want you to see. $90. They shoved it down violently to the mid-80s earlier in the session. They desperately tried to pin it under 90 into the close, and yet aggressive buyers kept dragging it right back up relentlessly. That kind of tug-of-war isn't normal market volatility at all. It's a straight-up battle for a psychological level, a headline level, and if you understand the mechanics, a critical leverage level. And here's the part that should make you sit up straight. While that fight was happening, the paper futures market printed volume numbers that absolutely dwarf real-world metal production. We're talking about ounces being traded that the planet can't even physically produce in a year, in a market where physical supply is already extremely tight. That mismatch is the real story. The rest is just theater. Now, a quick request before we go deeper. My stats show a big chunk of you watch every week and still haven't subscribed to MarketPulseUSA. If you actually value this kind of straight, no fluff breakdown, smash that subscribe button right now. Drop MarketPulseUSA in the comments so I can see who's really riding with us. All right, back to the chaos. Silver didn't just move, it got punched hard. The kind of punch you only see when major options and major positioning are on the table. Price was shoved down into the high 80s, then crawled, then sprinted back toward $90. Gold had its own drama, dropping sharply and then fighting back toward the 4,600 zone. And the timing matters enormously. This wasn't midweek randomness. This was into the close, into key levels with the clock running out. Why would anyone care that much about the last minutes? Because weekly closes shape headlines. They shape chart signals. They shape margin calls. And they shape what a lot of funds, algorithms, and risk desks are forced to do next. If silver closes above 90, it sends a message. The dip got bought. The sellers couldn't hold it. And the next push is on the table. If it closes below, the media gets to run the same tired script. Silver failed. Silver rejected. Speculation cooled. And on and on. That messaging is absolutely not accidental. It's part of the game. Now let's talk about the game with real numbers. When I say 1 billion paper ounces, I'm not using a dramatic metaphor. I'm talking about the way futures contracts translate into metal. One standard silver futures contract represents 5,000 ounces. So when you see a day with, say, 250,000 contracts changing hands, that's 250,000 multiplied by 5,000. Do the math, and you're staring at roughly 1.25 billion ounces on the tape. And here's the punchline. The world doesn't mine 1 billion ounces of silver in a year. Not even close. So if the paper market can print annual supply in a single session, you're dealing with a market where the tail can wag the dog. That's why you can have days that feel completely irrational. It's also why the banker slam can happen so fast. A wave of contracts hits, stops get triggered, momentum traders pile in, and then once the objective is achieved, the same machinery can reverse it. If you're new here, don't get lost in the jargon. Just remember this. In highly leveraged markets, price is often a negotiation between paper positioning and physical reality, not a simple reflection of how many coins someone bought at lunch. Now, I want to rewind the timeline for a second so you can feel the sequence. Going into the session, silver was already on edge after recent highs. Then during the day, it got shoved down aggressively into the high 80s. That was the shock. Right after that, you saw the crawlback. 87, 88, 89, and then the magnet, 90. With about 20 to 25 minutes left, it was hovering just under $90, moving in tiny increments like it was walking a tightrope. 8 cents under, 12 cents under, 2 cents under, a quick poke above, then back below. That's the kind of microdrama most people ignore. But it's exactly where the big money cares, because every one of those pennies decides whether a pile of options dies or lives, whether a chart prints breakout or failure, and whether next week opens with confidence or doubt. And while silver was doing that, gold was running its own obstacle course. It dropped hard toward the mid-4500s and then snapped back, testing the upper 4500s again. If you've ever wondered why metals traders watch gold and silver together, that's why. When both recover after a hit, it tells you the pressure isn't isolated. So yes, the clock mattered, the close mattered, the level mattered. Earlier in the week, the paper market pushed through contract counts that translate into over 1 billion paper ounces traded in a single day. Let that sink in. 1 billion. 2 days in a row, we're in that neighborhood. Meanwhile, annual global mine supply is a fraction of that. Even if you don't know the exact figures, your instinct should scream, this is leverage, stacked on leverage, stacked on leverage. When you see that, you're not watching a simple supply and demand auction. You're watching a financial instrument being used like a steering wheel. And that's why the last day of certain events becomes a magnet for manipulation attempts. There were 2 big calendar reasons the push-pull intensified. First, options. When options expire, the incentive to pin price to the most profitable strike for the big players goes through the roof. If price finishes just under level, a mountain of calls expires worthless. If it finishes just above, the opposite happens. It's not conspiracy, it's incentives. And in markets where paper volume can flood the tape, incentives can look a lot like sudden price action. Second, rebalancing. Every year, you'll hear the same storyline. Some index will rebalance, therefore metals must crash. It's the perfect scare tactic. Because it sounds technical, it sounds official, and it gives people a reason to panic sell without understanding the actual scale and timing. Most of the time, the reality is smaller and shorter than the fear narrative. And here's the clue that fear was overcooked. Despite all the talk of a massive crash, silver didn't implode. It fought, it dipped, then it reclaimed. That's not what a market top looks like. That's what a contested breakout looks like. Now, if you're feeling frustrated because we should have been higher, zoom out for 2 seconds. Just days ago, $90 was essentially an all-time area again. Markets don't usually teleport from a breakout to a smooth, straight line. They fight, they retest, they shake out leverage. And then if the underlying pressure is real, they continue. But I promised you a moment that should make you pay attention. Here it is. During this exact period of high tension, the US Mint's pricing on Silver Eagles showed numbers that are frankly outrageous compared to spot. Proof coins priced around the $170 range, uncirculated around the high 160s. That number didn't come from a rumor. It popped up while people were watching the close and comparing notes. Someone flagged it, others checked it, and suddenly everyone was asking the same thing. Why would an official outlet price a 1-ounce silver product like this? And notice what it does to perception. If a new viewer hears silver is around 90, they think, okay, expensive, but maybe manageable. Then they see a government product listed at nearly double that, and their brain does the math. Either premiums are going insane, or spot is not telling the full story, or both. This is where you have to think like a risk manager. If you're a mint or a large dealer, you don't care about today's spot as much as you care about replacement cost. If you sell a product today and you can't replace it next week without paying more, you either stop selling, ration supply, or jack the price high enough to protect yourself. That's basic inventory defense. So those numbers are not a prediction, they're a stress signal. Now zoom out and connect it to the close battle. When the paper market tries to pin price below 90, while retail channels flash prices implying much higher replacement risk, it creates a credibility gap. And credibility gaps get resolved in one of two ways. Either physical loosens and premiums collapse, or paper price rises to reduce the pressure. Sometimes you get a messy mixture, but gaps don't stay wide forever. And because this was happening right as options expired and rebalancing headlines were peaking, it also exposed something about the media cycle. The fear headline machine wants you to believe every dip is the start of a crash. But in a real crash, you don't see immediate snapbacks and tightening physical signals at the same time. In a real crash, premiums often collapse because nobody wants the product. Here, people still want the product. That's the difference. Now let's keep it practical. If you're sitting at home, you might be thinking, okay, but what should I actually do with that information? First, don't confuse collectible pricing with raw metal value. A proof coin is not a generic bar. But also, don't ignore the direction of official premiums. Direction matters. Second, compare 3 prices, not 1. Compare paper spot, local shop buy-all spreads, and online or official product pricing. When those 3 diverge, it's telling you the market is under strain. Third, if you're buying, decide what you're buying for. If it's long-term metal exposure, don't let a single day's candle bully you. If it's short-term trading, manage risk tighter than you think you need to. Because these swings are designed to punish leverage, and I'll add one more. Watch liquidity. When dealers say volume is crazy, that sounds like good news. But it also means their cash is tied up. A shop can sell a lot and still feel squeezed if replacement stock is expensive and buyers are coming in nonstop. That's when you start hearing things like, we'll buy, but at a bigger discount. Or we're not taking that category today. Or we're limiting certain items. It's not because they hate customers. It's because they're defending their balance sheet. So if you see weird buyback offers, like paying noticeably under spot for perfectly fine silver, that can be a symptom of liquidity strain, not a signal that silver is suddenly worthless. The spread is the stress gauge. Regardless of what you think about premiums, collectibles, or government pricing, this tells you something important. The retail product pipeline is either under stress or the issuer is protecting itself against what it believes may come next. And no, you don't have to believe that the mint predicts the future to understand what it signals. When official channels jack prices that far above spot, it means one of two things. Either demand is ripping through their allocation, or their costs and replacement risk have changed, or both. In any case, it's not a sign of an easy, comfortable market. So here's the question. If paper price is flirting with 90, why are official products signaling 160 to 170? That gap is the tension point. Paper can be pushed around. Physical has to be sourced, minted, shipped, insured, and replaced. When those two worlds diverge, it's a warning light. And it wasn't just one government site. People walking into local coin shops reported premiums widening. Generic rounds and bars a few dollars over spot. But eagles and other high-demand items at much higher premiums. Some dealers, by their own reports, were even hesitant about taking certain categories of lower purity silver because refiners tighten standards when throughput gets jammed. Does that mean no silver exists? No. It means inventory is moving fast. Cash flow gets strained, and replacement becomes harder at the speed the market is demanding. Now, the mainstream framing you'll hear is always the same. If the price is rising, it's a bubble. But they never ask the obvious question. What if the price is rising because the price was wrong? In other words, what if this isn't a mania? What if it's price discovery catching up to reality? Because when you have a market that trades more on paper than can be delivered, you can hold the lid on for a while. But when physical demand stays persistent, the cost of holding the lid gets higher. And eventually, the lid doesn't pop politely, it pops violently. This is why the phrase you keep hearing, backwardation, matters. It's a nerdy word, but the meaning is simple. People are willing to pay more now than later, because now is scarce. When that shows up, it's a signal that immediate metal is valued more than a promise. And when the market finishes in backwardation, even slightly, it's like the physical market whispering, "Your paper price is cute. Let's see if you can source the real thing." Now, I'm not here to sell you fear. I'm here to translate what the tape is saying. So let's break down the key signals from this episode and what I'll be watching next. Signal 1, the defense of 90. A price level becomes real when it gets tested and defended, not once, repeatedly. The entire week, you could see attempts to shove silver away from 90, and yet it kept crawling back. That's not a guarantee of anything. But it's a sign that buyers are not satisfied with the price they're being offered. Signal 2, the absurd paper volume. When you see day after day with paper ounces that rival annual production, you're seeing the scale of leverage that can cause sudden spikes and sudden dips. That's why you can't read these markets like a simple farmer's market. The leverage is the amplifier. Signal 3, the retail and official premium response. The US mint price tags didn't happen in a vacuum. Local premiums didn't widen because everyone is relaxed. Premiums widen when replacement feels uncertain. Signal 4, vault movement. Whenever meaningful amounts are withdrawn from vault systems tied to delivery, it tightens the float. And when the float tightens in a market where paper claims are huge, the system becomes more fragile. You don't need to know every detail to understand the basic physics. Less available metal plus more claims equals more stress. Now, let me hit you with something a lot of people will miss. The weekend close is not the end of the story. The next story is what happens when the US market is quieter and the Asian market trades. Because while some Western markets pause, other exchanges stay active. And when price discovery happens outside the most controlled arena, you sometimes see the gap effect on reopen. Prices jump because the market reprices when the lid isn't being sat on as hard. Here's why. Even when one big venue pauses for a holiday or weekend window, other venues don't politely stop caring. The Asian session can trade, regional futures can price, and physical dealers can keep quoting. So the close is sometimes just the end of one arena, not the end of the fight. And in this particular episode, overseas pricing was already flashing strength. One major regional market was marking silver up near the high 90s, while the Western paper market was still wrestling with a 90 handle. That is exactly the kind of divergence that makes reopenings spicy. Because when one venue reopens after being closed, it doesn't reopen in a vacuum. It reopens into the world as it is, not the world as it was. That's how you get the gap behavior traders talk about. Now, what to watch after this close? 1, watch whether 90 becomes a floor or stays a ceiling. The market just told you it cares. If it holds above, watch for buyers to treat dips toward 90 as opportunities. If it falls below, watch whether it snaps back quickly. The speed of the snapback is the clue. 2, watch the overseas pricing. If overseas markets hold higher pricing while one venue is shut, reopens can gap. And gaps can trigger momentum buying because risk desks and algorithms react to the new range. 3, watch the physical premiums. If spot chops sideways but premiums stay elevated, it means the tightness is underneath. If premiums compress, it may mean supply is catching up temporarily. 4, watch the vault flows and delivery pressure. Big withdrawals during non-delivery months are a loud signal, and if the next major delivery window approaches with a tight float, the stress can increase. If you found this useful, subscribe to MarketPulseUSA right now. Drop MarketPulseUSA in the comments if you want me to keep covering these battles. In our next video, we'll break down what happens when the next session opens, and whether silver can hold this critical level. The bankers tried to slam it. They tried to scare you. They tried to pin it. And yet, silver fought back to the line that matters. That doesn't guarantee tomorrow. But it tells you one thing clearly. The story is not over. This is Market Pulse USA. Stay sharp, stay informed, and I'll see you in the next one.